Hi everyone, let's cover my 1 hour time frame Elliott wave scenarios on Bitcoin, starting with this bullish scenario where we're looking for a continuation of the range and upside at a later stage. This is a sideways a WXY complex corrective structure where we have a first zigzag in wave W, a zigzag in wave X, and then we look for a triangle or a flat in wave Y. We're not looking for a zigzag in wave Y because wave X touched the 0.7 Fibonacci taken from the start to the end of wave W, which significantly lowers the probabilities for a double zigzag WXY, which would be a sharp corrective structure. So therefore, in wave Y, we're looking for a triangle or a flat. The triangle is the blue polyline, A, B, C, D, E, continuation up. And the flat is the yellow polyline A, B, C, and then eventually continuation to the upside. From a probability perspective, a flat in wave Y will have higher probabilities than a triangle in wave Y, quite simply because we do not have enough information here to give a triangle the highest probabilities. Usually you're going to be waiting for a triangle wave D, looking for a wave E before you really start considering a triangle in a wave Y. The most bullish scenario is what you see here on my chart. In this scenario, we once again have the zigzag here to the downside ABC, but this is the end of your corrective structure and you're looking for bullish continuation. Now here we then have an impulse 1, wave 2 finished. Second impulse 1, looking to finish this wave 2, possibly finish at the low, doesn't matter, it's a corrective structure, and then you want price to move up. Invalidation is the low at 107.5K, and you want price to take out this high at 110.8K. What is very important here is that this move to the upside has to be a 5-wave impulsive structure. So 1, 2, 3, 4, 5. Of course, possibly a diagonal. Let's just say it has to be a motive wave, being a impulse or a diagonal structure. But most common would be an impulse, 1, 2, 3, 4, 5. Touch some resistances, maybe create then another wave 2 for then another lower degree 1, 2, and then eventually move to the upside in a very impulsive wave 3. If we look at some of the resistances that we have to the upside, and we still have the daily naked point of control, which was missed with the high we created yesterday, right? Yesterday, we were looking for price to take out this high at 110.4K, which happened nicely with this wick, but we actually just missed out on touching the daily naked point of control. So that's still interesting resistance to the upside. If I open my other levels, you can see what's going on at the moment. These levels here are new compared to yesterday, but these ones were already there. So we have 110.9, 111.4, and then around 111.78K, there is some resistance. To the downside, we actually have a similar story. So price moved to the downside here, and we just missed out on touching volume levels here, weekly naked point of control and a daily naked point of control. We moved back into this order block, which acted as support. So we have some interesting resistance to the upside, but we also have very interesting support to the downside. But the invalidation for this scenario is very clear. Now, something that is important to note is this, right? High volume in the top is C-ish, which makes this scenario at the moment an alternative scenario compared to, for example, the WXY. So if we zoom in, then yesterday, as mentioned, probability is higher to take the high. And I was observing as price moved up that this move had a high amount of volume, right? So we can count an impulse here on the lower time frame. We have 1, 2, 3, 4, 5, correction, 1, 2, 3, 4, 5, that's your wave 3, that's your 4, and then your final leg up is your wave 5 on the highest amount of volume. Now, the highest amount of volume in a wave 5 is not very typical for a wave 1 or a wave A, more typical for corrective structures, but it is quite typical for wave Cs. Wave Cs do like to end on a high amount of volume, which is something that earlier today we discussed in Discord as well, and the gold group Pistachio and I had the same thought. This looks C-ish as written over here as well, and then a 1, 2, 3, 4 final leg up in a 5. So it does impact the probabilities negatively for this being another wave 1 and then a multi 1-2 as per this particular scenario. And then we get to two bearish scenarios where this is the first one. So here we have an impulse to the downside in a wave A/a wave 1, a finished ABC to the upside, which therefore could be your finished wave B or 2, and then you look for price to move towards the downside. Now that means that this now has to be some sort of a multi 1-2, like a 1, 2, 1, look for another 2, and then a wave 3 to the downside. I'm not really fancying a multi 1-2 here at the moment. This second wave 1 would be much longer in time as well compared to your first wave 1, which would negatively affect the probabilities. So it's not really something I keep in mind, but something you have to remember is that this structure to the upside has to be a 3-wave corrective structure. And then, of course, you impulse towards the downside. So at least that's something to keep in mind. Something I would like to see, though, is for price to at least move into the fibs, meaning at least touching the 0.382, which is taken from this lower high here, this lower high, to the current low on the chart. So if we would count an impulse here, 1, 2, 3, 4, 5, finished. Maybe there's a double here, 1, 2, 1, 2, 3, 4, 5, another 4, another 5. In that case, you take the fib from the high to the lower low, right? But then you want to see price move at least into the 382, which generally is a minimum retracement target for a wave 2 if you're looking at it. Now, if price is touching the 886 taken from this high to this low, or if there's a new low, the new low currently sitting at least at 110.3K, then a multi 1-2 significantly decreases in probabilities, and it's not really the scenario I mostly keep an eye on at the moment. But nonetheless, it is interesting to keep in mind. Invalidation is the high at 110.8K. And here you want price to take out this low at 106.6K and move into lower support areas. Then finally, the second bearish scenario where the impulse here is shorter. Now it finishes here instead of at this particular low. So your 5-waver is in. And then you start with a flat in a W. That's your wave X, and then ABC in a wave Y. What lowest probabilities for this scenario is time. Your wave X is incredibly short compared to your wave W, which can happen. A zigzag can be incredibly short in time, wave X's as well, but it is noteworthy nonetheless that wave X finished before this vertical line on the chart taken from the start to the end of W, comparing W with X in time, which is not something you see too often, so that is something to keep in mind. And then in wave Y, you're looking for a wave A, wave B, and a 5-wave move up in a wave C. Now, the biggest difference here with the bullish scenario, where you're also looking for a 5-wave move towards the upside with the same invalidation, is that after 5 waves, you get an impulsive move to the downside. So 1, 2, 3, 4, 5, and much lower you go, right? In the bullish scenario, you also get a 5-waver, but this is a 3-wave corrective structure to the downside, not a 5-wave impulsive move to the downside, right? So that is an important difference. Now, we do have some news today here. Wednesday, the 28th, 8 p.m. Central European time. Make sure you trade safe. It can increase the volatility on the chart. And if we then look at the conclusion and the polylines, where the polylines basically show you a summary of the expected price action. And if you then look at the expected price action and the direction of the polylines, you generally get a bit of an idea of what the highest probability directional bias is. So based on the polylines here as well, you can see that most of the polylines look for price to move towards the upside and take out the high at 110.8K. Even in the most bearish scenario, which is your red polyline, it would be nice to eventually move into the 382 Fibonacci as explained in the analysis. But that's what I write here. Most scenarios take out the high at 110.8. The recent local high made yesterday was done so on a high amount of volume, which is more C-ish behavior than wave 1 behavior, which does negatively impact the most bullish scenario, but it's still interesting to look for a continuation of the range. Personally, keeping an eye on the WXY at the moment, / a continuation of range, right? Alternatively, bear 1 and bull. So if I look at the scenarios or open them for you, then this is something that I at the moment do keep in mind, where we then have a W, X, and a wave Y. Now, your wave A of a triangle or wave A of a flat structure can end wherever, right? It can still move towards the downside. That is no problem, as long as your wave A is a 3-wave structure to the downside. And then eventually you create wave B of a triangle or wave B of a flat structure. So you just have to be patient for price to eventually turn around. Now then the alternative, bear 1, which is this scenario here. As mentioned, preferably we do touch that 0.382 at some point. If price is going to gun for these lows, then look for this fib to be pulled from this high to wherever that low is and eventually get a retracement, because that is something you're looking for in this scenario as per the analysis explained earlier. And an alternative is, of course, then also the bullish scenario where we get a 5, 3, and 5. At the moment, not really fancying this one here too much because your wave X is so incredibly short compared to your wave W, but I will keep it in my folders because it is interesting nonetheless. Now you can see that I wrote something more here as well, because if we are looking for price to eventually take out the high at 110.8k once the move down here is finished, the structure is going to be very important for the probabilities of the different scenarios. Because in the WXY, the move up has to be a 3-wave structure, not a 5-wave structure, and preferably it takes out the high, as a flat has higher probabilities at the moment than a triangle. In the bear 1 scenario, which is this one here, you also want a 3-wave structure to the upside, but you don't want to take out that high. And then you want to impulse to the downside. That's a difference with the triangle. Triangle is a 3-wave up and a 3-wave down, and then you go back up again, right? Important difference with the bear 1 scenario, right? Or at least that's the name of my folder. And then in the bullish scenario, of course, this has to be a 5-wave structure to the upside, not a 3-wave structure to the upside. It's 5 up and 3 down, right? Which is, of course, a big difference with the bear 2, 5 up, 5 down, right? So this is important. It will keep you sharp, right, when the waves are slowly forming here on the chart. Let's see what we get today, though. I hope that this video was helpful or valuable to you. On the left, you see a video on the simplest way to use and trade Elliott waves without even counting. And on the right is the Elliott Wave educational playlist to help you understand more about Elliott waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye-bye.